Welcome to the Real Advisor Podcast, TRAP, TRAP. Please follow us and join in the conversation on Twitter @Advisor Podcast, where you can suggest ideas and themes you'd like the TRAP team to discuss. Also remember to like and subscribe to our YouTube channel and leave a 6 out of 5-star review on iTunes. Doing all this really helps us, which means we can do more to help you. Now let's head over to the studio for the latest pile of TRAP.
Yes, indeed, dear Trappists. Welcome back to what many people are calling episode 24 of the Real Advisor Podcast, TRAP, TRAP. My name is Lick Lincoln, and joining me as ever are the three other horsemen of the apocalypse. Andy Hart, Carl the Voice Widger, and Alan the Storyteller Smith. Now, gentlemen, we have a show packed full of absolutely nothing, so let's start unpacking it straight away. Andy, give us 3 more super high-energy review reads.
Well, if you were reading the show notes, Nick, you can see there's only 2 today. So here I go, get cracking. The first one is from Jackie DSPWS Limited, entitled Brilliant Banter and Beneficial Brainstorming, 5 stars. Late to the table, but a great podcast for those interested in joining the financial planning community, those in it, and those who wish to call themselves seasoned professionals. I've never really labelled myself as a planner rather than just an advisor, but I know I've always given a service that's different from the norm, goes beyond the transaction, is about full engagement and being involved in all aspects of the client's lives. The value both ways is enormous. Love the podcast, especially because now I don't have a big network of fellow advisors. Perhaps a bit of girly input wouldn't go amiss in the future. Always happy to add a feminine touch. Keep me smiling, guys. Next up is Dirk. We call him Lunch Club Dirk, all the way from SA, South Africa. 5 stars again. The Real Deal podcast for real financial planners. Really enjoy listening to this podcast on my hour-long drive into my office in the city. Years of experience, common sense, and lots of humour from the TRAP team make this a great listen and the best bang for buck, especially for active and young planners who want to improve their art. Thanks to all the TRAP team for giving back to our wonderful industry so generously and in such honest manner. Let's hope we finally get to have that lunch club. Dirk, back to you, boss.
Thank you, Andy. Yeah, the first review was, I think, from
Amelia's
It's
mum.
Amelia. That's Amelia's mum. I think Jackie is Amelia's mum. Amelia, our guest host on a couple of episodes ago. On the reviews, Trappist, if you'd like to, not compulsory, don't have to, but if you're leaving a review, would you mind going forward just dropping your Twitter handle, if you're on Twitter, at the top of the review? Because that way we can link to your review in the show notes, and it helps us just identify who the reviewers are, because it's normally fairly anonymous. You don't have to do it, but it would just help us if you could do that going forward. Now, the wonders of technology. Mr. Smith, where
Hello.
are you, and how are you running your business from where you are?
I am in wonderful country of Turkey. I'm in Turkey. I'm in a hotel on the beach, and they've kindly lent me an office. So I've got my laptop with me. So business as usual, gentlemen. Life carries on, which is an interesting topic. Before we sort of open that up and talk about that a bit more, which is kind of, when you are on holiday, do you close the shop? Do you continue? Some of you guys are running sort of solo practices. We've got a few people in our team. So what do you do? But I think there's an interesting connection here, because I'm here with family, wife, kids, and we're staying in this hotel. And we very first came here. This hotel that we stay in is not on the tourist map. It's not. You can't generally, access it through kind of Thompson Holidays or whatever in the UK. It's a bit obscure, kind of hard to find, hard to get to. But there's a reason that we can. There's a little story behind this, so you can pour yourself a quick drink. Won't be that long. But I first came here 12 years ago, and we've been coming every single year. Obviously, with the exception of, what's it called, Nick? That Wuhan flu episode where we didn't come for 2
Fauci
years.
flu, Wuhan bedwetting, yeah.
Yeah. So apart from that, we weren't allowed to travel. We've been coming here every single year. And the reason for that is about 12 years ago, friend of mine, known to us all, Paul Armson. He's famous for having this huge yacht. He's got a beautiful yacht, Oyster. It's I don't know if it still is, but it was moored out here. And all those years ago, Paul said, "Look, do you want to come sailing?" There's a few of us were going to go sailing around his yacht. and and do sort of business, chew the fat, talk about issues, challenges, and give each other. So about 4 or 5 of us went on this boat trip all those years ago. And so Paul invited me, do you want to come sailing for a week? And I thought, yeah, I'd love to. And then so I went home, told my darling wife. Now, you guys know the beautiful Scandinavian, my other half. She listens to this. And in classic Katrina style, so I said, look, is it okay if I go sailing for a week? And she says, of course it is, darling. But what's in it for me? And so I said, well, you can come as well. So what happened? Paul had discovered this hotel that we're staying at, because he sailed to this hotel once. He said, beautiful little hotel. His partner and him went here. So I think they stayed here, had dinner, had a drink. So he told us about it, never heard about it before. So the whole family came across. I think Sean, my son, was just a baby at the time. And we came here. So I dropped them off in this hotel and literally dropped my bags or dropped them off. And I went off, got a taxi to the marina. Paul picked me up in his dinghy, and we went sailing for a week, and we had the time of our life. Fabulous. It's a fabulous part of the world, and just sailing around all these sort of nooks and crannies and places you can't access other than by boat. And we had the best time. So I came back after sort of best part of a week sailing and met Katrina and said, so how is it? And she said, this is the best place I've ever stayed at. And and so we've been coming here ever since. And I think it's quite interesting. People often say to me, why do you go to the same place year after year? There are so many places you can go on holiday. And the answer is, it just works. Everyone likes it. I love it. Wife likes it. Children like it. We used to bring my mother-in-law. She loved it. And it's just one of these things that it just works. And I just thought there are some similarities. This is my tenuous link. There are some similarities with the investment world. Because people say, I've got some more money to invest. What shall I do with it? And we say the same thing. Put it in the same. Well, but haven't you got anything else? Haven't you got somewhere else you can put it? Is there something more interesting? So we go back to the same place. Of course, we take other breaks and other vacations in different parts. But we basically found this thing that just works year after year. And so we keep doing it. So that's where I am. And this is where I'll probably be again this time next year. Inshallah, God willing. There we go. Next.
Excellent. Thank you. And you were right. That was extremely tenuous, but well worth waiting for. Okay, we've got quite a few topical tidbits for this episode. So if we say something, don't feel obliged to comment, chaps, unless you've got something of value to add. So this next point might be a case in point. We're thinking, TRAPist, about having a live event in 2024. If we can tie it around episode 50, it would be this kind of time next year. So in the so-called show notes, I've knocked up a Google form, and if you would like to come to a Trap live event, just simply leave your email and name. That's all. We just want to get an idea of the interest that's out there. And so if you are interested, please let us know. And then we can start planning for it. It'll be shits and giggles. We'll maybe have some special guests. God knows what we'll do, but it'll be fun. Audience participation, Trap Live 2024 for the 50th episode, maybe this time next year. Okay, Mr. Hart, Google reviews.
Yeah, so Google reviews obviously is a big thing whilst building a business. I've got quite a few of them. I can't remember how many. I think you've got quite a few, haven't you, Nick? I just thought I'd bring it up. I don't know if it's going to be a quick subject or a bit more of a detailed subject. So, yeah, I try and remind myself to ask clients to leave a Google review. It's quite quick. I think they just need to have a Gmail account. And I know some other advisors are quite hot on it. Things like Google Maps and just generally searching on Google to find a financial advisor in your area is quite a common thing. So, yeah, anyone else got anything to say on Google reviews?
I did go through a phase of asking clients for Google reviews, and I just fell out of that phase. So I'm not really. I've never used Unbar. I don't vouch for it. I've never used any of those ones. I don't have a particularly strong view on it, either way. No,
well,
gents?
No, we've done the same. We went through a spurge. We got about, I can't remember, maybe 20, 25 or so, which is pretty decent. But then we forget about it, because the last one's probably a year ago. I don't know if that's even worse if you got a load of them, because they're all dated, aren't they? So then you get a bunch of them at a certain time, and then you don't get any for a year or two.
I took the sort of cynical view that my reviews were all 5-star, and the more I asked, I was bound to get one that wasn't. So I think I'll just get my average of 5. A bit like the podcast reviews, actually, which are back to 5 out of 5, which is amazing after 100.
Apart from my podcast, which was, thank you, Andy Hart, publicly give you a vote of thanks for the 1-star review.
What a
Who
thing
needs
to
friends,
do.
eh? Who needs
Okay.
friends?
And you can't undo that once you give a 1-star review, right? So if someone thinks that's quite funny,
can you not?
You can't undo
You can't
it.
change
no.
it.
Maybe after Alan going on for about 2 hours at a pub one day about his 5-star record, but I thought, you know what?
One-star
Oh, I'm going to go
review.
home after a few beers. And I actually forget
With friends
I
like
forgot
these,
I
who needs
actually
enemies,
did it,
eh?
but I apologise
Yeah.
publicly to you. But it shows you're
Oh,
human,
okay.
and all good podcasters need a 1-star review every so often.
How have we got the podcast back to 5 out of 5 when we didn't someone leave us a 1-star review?
They did, but
Yeah,
I think
someone
someone
left
left
us-
121
No, it's
reviews. So the
three
average-
Star, and it brought it down to the closest was 4.9, but now we've got so many 5-star reviews, the closest is now 5, which is very, very rare. But yeah,
Okay.
interesting.
Yeah.
Okay,
Happy days.
good stuff. Right, what else? Okay, so the Centre for Policy Studies, which is one of the many gazillion think tanks in the UK, put out a report, I think it was last week, saying that in the UK there's 1.8 trillion in cash savings and a further 300 million in national savings and investments. And it was really just, well, as real financial advisors, we know the tragedy of having that much amount of money in cash, that people all generally defer to go into cash ISAs before they go into stocks and shares ISAs. That it's very difficult in the UK culture, and I imagine also in the Irish culture, to, if you want to take out a credit card, it's a couple of ticks. If you want to invest in the stocks and shares, it's a whole plethora of regulations and hoops to go through. And the UK is now way behind other European countries in terms of how much retail investors have in shares. It's 21% of the UK public compared to 28% in France and up to 84% in Spain. So again, just the tragedy of the masses, really, isn't it? 1.8 trillion languishing in cash. Bad enough at trend line inflation, but when inflation is double digits, it's just an absolute destruction of wealth on a scale that's hard to imagine. So this paper is trying to say, let's get people back into shares the way it was in the 80s and so forth. But good news, selfishly, good news for us, because our calling is still there. People need to be, despite the fact we bang on about it forever, the ignorance is widespread. The disease is pernicious. This idea that cash is safe and a good place to have your money. Any thoughts on that, gents, or should we move on?
Cash is certainly a topic now we're discussing a lot more with clients because the returns are so much higher. Fixed rates now are astronomically high. I know still they're below inflation and hopefully they're below investments, but it's certainly more of a topic. Certainly with people that run businesses have got cash in businesses and also private cash. So it's certainly become more of a discussion point with clients. When it was at zero and nobody was paying anything, it was just a move on from it. Whereas now it certainly is more of a discussion point, and it's continuing to sort of evolve as the variables sort of change. So yeah, it's certainly something I'm taking a bit more of a keen interest in. But yeah, your points are valid, Nick.
Surely it's just a question of identifying and understanding the purpose of cash. Why does anyone hold cash? We know it's access and liquidity, short term. That's all it's there for. We know for certain over any period of time, and certainly after tax and inflation, it's a guaranteed locked in erosion of capital, erosion of wealth.
Yeah, but we know that, Alan. But the ignorance is enormous. Most people don't know that, and most people will leave a significant amount of their wealth in cash, not just for weeks and months, but for years and decades. Just out of a confusion about what the real risk is, and being told all the time by the culture that the great companies of the world are risky. There's this whole thing of confusing volatility with risk, which we know is not. But we're a tiny sliver. Even within our profession, we could say that we're a segment. We're not the profession en masse. There's still, careful how I word this, but I don't think not all advisors think the way we do by a country mile. And we're, that's already a small slice of the UK population, and we're just a slice of that slice. So
do you see that thing? See what I posted on LinkedIn a few weeks ago about, can't remember, what's that, the name of that lady who's, super, celebrity on Countdown?
Riley,
and
Riley.
Yes.
She's got a master's. She's
Rachel
got an
Riley.
advanced. Rachel Riley. She's got a master's in advanced mathematics from Oxford or something like that. Super, and she's really, really clever. There's no question about it.
Intelligent.
And yet she one of these what do I do with my money articles in the Sunday Times, and she said, it's all, I don't gamble, so I don't invest in stocks. And she says, I own a property, I'm going to pay off my mortgage or something. And I just posted that, and there was just so many comments in support of her saying along the lines of, "But the stock market is just gambling. I'd rather just keep my cash," sort of thing. And this,
Well, there you go. Yeah.
as you say, this impression that it's just gambling is. Yeah,
we can't save everybody.
Can't see it. So there's a link to the Centre for Policy Studies article in the so-called show notes, and I'll quickly finish on this. There's a link to another article from Yahoo Finance, which says the same thing pretty much in the US, that high net worth individuals, which is defined by this report as people with $1 million or more in investable assets, high net worth individuals in the US held over 34% of their portfolios in cash as of January this year, the highest level since at least 2002. So that's normally a screaming buy signal to pile into equities, if nothing else, because at some stage this money will rotate back into risk-on assets. See, I can talk like an investment manager. It's just bullshit bingo. All right, what's the next thing on the list? Mr. Widger, you've been quiet so far, but you've got some, talking of BS, 24/7 hustle.
Yeah, so I don't know. Twitter for me at the moment is I'm getting a little bit disillusioned, but I don't see your accounts. I've mentioned that before, right? But I'm getting loads of these guys telling me that they're getting up at 6 a.m. and they have a list to do, and they get through the list and they do it every single day, and that's what success looks like. And frankly, I think it's horseshit. I'm sorry, but it's like, life happens, and some days you're just busy with other stuff and you can't get through your to-do list. And for me, my to-do list is like, Andy corrected me on this analogy before, but it's like painting the Eiffel Tower, right? Because once I'm finished, I have to start all over again. It's just never ending. So me trying to get up and get through a to-do list, every day would be pretty pointless exercise. But I just as well think I did reply, and I got a few likes and comments on it to say, well, what happens when you just wake up and you're just feeling a little bit crap? And I'm not suggesting that, every day you're, I'm feeling a little bit crap, so I'm not going to do all the right things. But I it's just driving me mad. And it's all these guys who I'm probably just jealous because they all have six packs and they're all probably 27 and they're putting this stuff out that honestly, right, I think it's a little bit counterproductive. And I think it can get into people's heads that, if I'm not doing this, I'm a bit of a loser. And then that can be a self-fulfilling prophecy and you just kind of stop trying to do anything. So it's like, for me, get up, do your best each day. But some days you're just not going to be feeling it. And
it's all this social thing, isn't it? It's like the Facebook life, on Facebook, you've got these perfect families where everything's fantastic. When in reality, she's doing, I don't know, cake and he's into boys. But it's all performative. It's all performative. I mean, my day doesn't start until I see a picture of Raj Shah's gym for his 6 a.m. smash.
Yeah.
We love you, Raj. We love you. Okay,
He takes
is that
the
you
front
going
of the
Carl?
whiteboard, doesn't he? It does it very impressive.
Yeah,
Well done, Raj.
Yeah, I was probably, when I tweeted that and put it into these show notes, I was probably having one of those shit days. I was going, would you just shut up?
I think that's perfectly valid, Carl, to give yourself permission just to say, I'm not up for it today. Every now and again, just say, I don't fancy it. I'll go back to bed.
Exactly. Yeah, it's called
It's
life.
when those days become months, become years that you may just need to snap out of it.
Yeah.
Okay,
I'm
Mr.
2.5 years in. I'm hoping to turn the corner at some stage.
You can do it. This is the year, Carl. This is the year. Okay, Mr. Smith, the power of boring, repeatable success strategies. And you've even told me it's story time. No.
I've kind of talked about it. Nick,
he said in the chat to move on.
Are we
so
talking about what you do in the summer? Move on to Carl's point.
Okay, fine. Okay, the High Performance Podcast, Carl, now has an app.
Yeah, so I've spoken about the High Performance Podcast probably way too much. It's my favorite podcast by a million miles. This is stuff I listen to these guys, right? Because these guys do interviews with, it's not only sports people, it's kind of well-known people, and how do they, I suppose, get to their goals and try and, be 7.5, 8 out of 10 every day, right? As opposed to, you don't have to be 10 out of 10. Anyway, there's some absolutely amazing interviews on it. There's a back catalogue there of over 200 episodes. I would highly recommend you go back through it. But they've recently launched an app, and the app, if you want the code to download to be one of the pioneers for the app, listen to episode 200, which is with Dan Carter, which is really, really good, and highly recommend that. But they give the code, which I forget right now, for the app. In the app, then they have lots of other kind of extra things. They do like kind of summary talks of some of the interviews. for example, in the Dan Carter thing, that was a live event, so they did the Q&A from that. I just think the app is really, really good, and the back catalogue there, to have that in one app, in one place, I think really outstanding. And like, it's about high performance in terms of leadership, but in terms of goals and that kind of stuff. So I think everyone can learn from it. And I was talking to Alan about this, and one of my kids had a little bit of a setback in their sporting careers, and I there was great learnings from the Dan Carter episode. So yeah, look, really, really good. I would highly recommend everyone downloads this app.
That's my culture corner gone. Thank you very much.
No. Well, see, I kind of put this in.
It would help if you guys looked at the show notes.
Yeah. No, I did look at the show notes, and I saw Alan had robbed my culture corner. So I said, I'm going to bring this forward into the topical tidbits.
Yeah, thank you.
Okay.
You're having a good day today, Carl. Well done.
We love each other, really.
Mr. Smith.
Bastard.
Mr. Smith,
Right.
Fidelity Junior ISA, no fees.
Yeah. Well, this is just a little thing that I learned this week. It comes from a slightly boring thing, but I think it's quite good. Because I've got more time, because I'm on holiday, as you do, I was checking my kids' junior ISA accounts, which are Vanguard Junior ISA in whatever global equities, obviously small cap something or other. And I was sitting doing a little chit chat with my 14-year-old son. And just explaining, because it's how it went, how the value's gone up, and just that basic stuff. Because I think it shows the top 10 holdings. So he owns a little bit of Apple and Amazon and Tesla and all that sort of stuff. So it's quite a nice little thing to have a chat about, and he's just quite fascinated. So I posted something about that on social and on Twitter, and somebody came back and responded and said, but you could have done it. Because I said it's amazing. It's almost this is sort of heartism. It's financial magic. It's the closest thing you get to magic. You can own a little bit of these, world-class, extraordinary businesses, and for practically for nothing. And what it's like 20.22 or something, 20 odd basis points. And somebody came back and said, well, you're not that clever because you could have had it with Fidelity. So I went on and checked Fidelity. I didn't realize this, but for junior ISAs, Fidelity have zero charges. So there's no fees at all for them, and they've got Vanguard funds. You can actually buy a Vanguard fund for lower cost than you can buy Vanguard directly, and they've got all the other kind of Fidelity global equities, and they've got one. They advertise, it says our funds start from 5 basis points. I couldn't find which one it was at 5 basis points. The ones I saw were about 11, 12. So if you really are looking for a super low cost junior ISA for your kids or your clients' kids, it looks like Fidelity. This is obviously not advice. Do your own research, but Fidelity looks like a decent. Yeah.
Can I stop you there? That no fee deal doesn't apply to advised clients. There's a different charging structure for advised clients.
Fine.
Okay.
Yeah.
Good.
Right. Okay. Thank you for that. Mr. Hart, flexible ISAs.
Well, yeah, just following on from Alan's point. So you're telling me that you didn't do an ATR for your newborn children? Wow. You just picked their funds?
Did not.
Funny that.
Exactly
Funny
right.
Funny how that works. Yeah, following on
Nuts.
the incredibly boring ISA theme, I've got a client who's a financial planning client, not an ongoing client. Anyway, this flexible ISA thing, he needs to draw out about 300 grand temporarily and then replace it when he gets a bonus in early 2024. And the legislation came in about this that was going to force all ISA providers to offer flexible ISAs, and then they changed the rules right at the 11th hour and said it's optional. So basically, almost nobody has done it. And stocks and shares ISAs being flexible for D2C, almost none of them exist. All the providers that you think would do it, HL, Interactive Investor, AJ Bell, they don't. I think Vanguard's the only one who's D2C that does it, that you'd actually want to become a client of. There's a lot more that do it on the advised channel. But yeah, I just thought I'd loosely mention it. I know a few other advisors might be interested in that. That's it, Nick, on my flexible ISA talk, unless anybody's got a point on that.
No, that's fine. As ever, Transact, I think, brought it in pretty much the day after the legislation was introduced. But I know some big companies like AJ Bell and Aegon are working on it. Well, it was brought in 2-3 years ago. Just on the junior ISA thing, funny enough, this morning, I had an email exchange with a client because their daughter is turning 18 soon. And he said to me, she's got this junior ISA, which I didn't set up. I inherited it. I think junior ISAs are the work of the devil. And he said, what happens at age 18? I said, I don't know. Let's find out. So I'm going to find out shortly what happens with it, because obviously then it becomes the daughters, and now is she a client of mine? Because they're no longer sort of nested under the parents, Auspices, I don't know. Going to find out. Can't wait.
What's your problem with junior ISAs, Nick?
Because they revert to the kid at 18.
Isn't that a good chance for them to sort of test themselves in a monetary?
Andy, to spunk it. No,
maybe
40,
or maybe not.
Maybe, yeah, but, yeah, thanks. Yeah, obviously, maybe or maybe not. But I think it's a pretty poor idea. Most husband and wife, 40k ISA allowance every year. Most people, after mortgages and taxes, aren't going to use that up if they've got young kids. Have a sub ISA in the parent's name for urchin 1, urchin 2, urchin 3. Do it again on Transact, a couple of clicks. Dead easy. JISAs are a stupid idea. You've got a Voyantis user group, my friend, on the 12th of August.
Yep, very quick note on that. So the Voyantis user group, we used to do it probably twice a year, didn't we, Nick? Used to be face-to-face. And then we moved on to Zoom, and it probably works better on Zoom. And there's a shed load of new changes for Voyant Go. Lots of new features being added into the system, the gift that keeps on giving as such. Anyway, on the 12th of October, me and you will be hosting the next Voyantis user group. And if you want to grab a ticket, you just go to thevoyantis.com. It's on the homepage link, or Voyant Mastery. And again, it's on the homepage, a link. So that's it for that.
Okay, you and I will be hosting.
Do we charge for advertisements now, or is that?
Don't you start,
free?
mate. Don't you start. You've milked
I don't know,
right?
Carl, but you mentioned Dan Carter about 78 times over the last 2 podcasts, so I think there's something with you and him going on. Mr. Hart, IHT, UK constituents, and a bloody graph.
I mean, again, this is probably for a wider discussion, but there was a sort of the top 50 paying constituents with inheritance tax in the UK, and I put a link in the so-called show notes. So Richmond Park is the number 1 payer of inheritance tax in terms of a constituency, and then it's Esher. So Richmond Park had 159 households pay this. David Hearn put a link on this, link about this on Twitter. Obviously, inheritance tax because of wealth being created, and estates above the thresholds means more and more households are paying it. I think it's got quite increased quite a bit in terms of what the revenue is generating. I think it's way over 6 billion now. I think it's doubled in the last 10 years.
Did I read somewhere that in the UK they're talking about not having inheritance tax anymore or something like that?
Oh, it's a thing came out last week that the government may get rid of inheritance tax. It's just one of these ideas that's been floated in the media. Even this shambolic government, I can't believe they're that craven as to do that just to get... Again, it's only like 6% of the UK population pays inheritance tax anyway, so it was such a bad...
It does raise a few billion.
Yeah, but it's not a lot.
Yes, over 6 billion. Where I live is number 10 on the list. Pinner, Northwood, etc. Obviously, it's a lot of the London boroughs that are caught up by this.
It's quite an interesting list, though, isn't it? I think that there's a marketing idea if you just target mail-shot inheritance tax planning in Richmond, Esher, Finchley,
Golders Green, Beaconsfield. Yeah, these are all the...
Hampstead and Kilburn. Boom. There we go.
There we are.
There you go, Kilburn South. There's your chance to get in.
And then they changed the legislation, said there's no inheritance tax. There goes your niche.
Well, don't cut inheritance tax, cut bloody income tax. Okay, done on that, Andy? Interesting.
Yeah, done on that. Yep.
Okay, and the next one is the final topical tidbits. Today we've had loads, but there's loads going on. Even though we're supposed to be in the dog days of summer, it's always busy in this thing of ours. You put a graph out showing some annuity rates for different ages and how they've increased in recent times. Yeah,
so the annuity rates have escalated quite aggressively, sort of from mid-2021 to now, so 2 years. The rates for younger clients aged 60 have gone up by about 60%. They were about £4,000. Now they're sort of just over 6.5. For slightly older clients, let's say 75, the rates have gone up by about 35%. So the mighty annuity that was not so mighty a couple of years ago is having a bit of its sort of resurgence as such. So it's definitely again a thing that people are talking about. The rates have gone up, as I say, quite considerably. So again, it's just something else that's in the wealth creation mix. We don't favour anything apart from what the numbers tell us, and then obviously what people's lives are going to dictate around the sort of financial products that are available to them. I don't think any of us have sold an annuity to a client for many, many years. I think that was discussed on a previous show. I'm sure some advisors listening to this are, again, thinking about them and they're sort of into the mix. I know I'm quite negative about annuities. I know you are as well, Nick. But yeah, so over to you, Nick. What do you think about this resurgence in annuity rates and potentially younger clients getting a 60% uplift from the bottom?
As we may discuss later on in the show, they're getting a 6% uplift because the long-dated gilt price has come down by 50%. So it kind of nets out if you're in long-dated gilts, which you apparently should be just before you buy an annuity. Listen, annuity rates have gone from absolutely abysmal to rubbish. Rubbish still doesn't mean they're good enough. And it's this thing of the fact, as you know, if you have a 3-decade retirement with trendline inflation at 40%, all those annuity rates on that graph, after 30 years, they've all lost about 70% of what actually matters, which is their purchasing power. 70%. I know, it's amazing what people will say when their salary depends on it. So you are seeing people who work for annuity providers coming out and sort of pushing up annuities now and saying they should be back on the discussion, the critical yield thing with drawdown and all this nonsense. And now this is their new thing, isn't it? Oh, let's make sure that clients have their essential spend covered. It's essential that we get essential spend covered when you're doing client planning and cash flow and so forth. And I thought about this. So let's have a scenario. Let's imagine we've got a lady called Michelle. She's 65, right? And she's come back to me or to any of us guys and said, listen, I've got 60K of lifestyle cost a year. 21K of that I designate as being essential. That's utility bills, council tax, insurances, groceries, petrol, just the dull stuff, but the stuff I have to do. 21K of my 60K is essential spend. I've got a state pension of 11K because that's what it is. So I need another 10K a year of guaranteed income to cover my essential spend. I don't want that exposed to investment risk. So you say, okay, Michelle, well, you'll be glad to know that annuity rates have gone up. So we can secure that 10K for you as a 65-year-old female, for really good terms. It's only going to cost you now £174,000 to get a 10K net annuity. And she's going, Christ, that's a good rate? Don't tell me what the poor rates were. Yes, Michelle, we have to spend 174K of your pension fund to secure a gross annuity of £12,500. People don't live off gross, they live off net. Tax is going to come off that at 20% because the state pension is taking up your income tax-free allowance. 20% off 12.5 grand is £10,000. That with your state pension is 21K a year of guaranteed income. Job done, box ticked. And she goes away happy thinking her essential spend is covered. She comes back next year for the annual planning meeting. And she goes, Nick, it's really good. My state pension's gone up by inflation. So the fact that inflation is 10% is really good. When does my annuity go up? And that's where you had this awkward silence with Michelle because you've got to say, yeah, sorry about that, Michelle. You want that annuity now to be £11,000 to keep pace with inflation, but we bought a level annuity. So you're going to have to work out which of the £1,000 of your essential spend is not essential. Tortuous way of saying this all this nonsense about using an annuity to secure against essential spend when inflation will just knock it out of the water. And nobody in their right mind ever writes an escalating annuity. An index, they are so expensive. You're giving up so much, it doesn't happen. So people only ever talk about level annuities and never talk about the inflation risk. So that's my current beef on annuity. When will they become good value? I don't know, but I still think for a 60-year-old, a yield of 6.4% before tax level, which will see 70% of your income purchasing power lost over 30 years at 4% inflation, still doesn't strike me as exciting. And then you throw in the fact that, as we all know, with drawdown and so forth, whatever's left behind currently goes to your partner if he or she is around, and then can go to whoever, your children, free of inheritance tax. That tax again that was mentioned a few moments ago.
Yeah, which is
guys, any more thoughts on this?
It's an important factor because otherwise
we've talked about this before. I remember saying that there are highly unusual, but more than 0 times when they are relevant. And I'm thinking about a rather elderly widow or widower, let's say single person without an estate, without children, or something of those circumstances, who just want a guarantee that this money will be paid month after month for as long as they're alive. It's unusual, but it's not impossible. But point well made, Nick. And just on a technical point, you don't pay the same amount of tax if you just buy an annuity with cash, purchase life annuity. There's slightly more tax.
Yeah, but that's kind of sorry. That kind of suits my argument because the purchase life annuity market doesn't really exist. Annuities only existed because with pension funds you had to annuitize once upon a time. If annuities were so great, people would be annuitizing their ISAs, their unit trusts, their cash. I think there's one provider now in the PLA market. One provider.
Is that right?
It just doesn't happen. People just don't like them. They had to have them with pensions because them's were the rules. But outside of that, they just were never done. They were never. Technically, you're right about this. Yeah, some of it is regarded as return of capital, isn't it? It's not all taxable the same way a pension annuity is.
All right.
Yeah, probably reduce it by about 80%, 90%. Okay, back to you, boss. What's next?
Okay, well, I think we've somehow managed to get through all the meat and potatoes. The topical tidbits. So let's move on to, I think, the meat and potatoes. And this is kind of links into what we were just talking about there with annuity rates and so forth. Obviously, they're linked to the price of long-dated UK gilts. And a friend of the show, I believe he listens to the show, David Penny, he put out a graph on the interweb. He's at David Penny PRW. That's his firm, Penny, Rudd and Winter. He put out a graph showing the decline of the Vanguard UK Long Duration Gilt Index Gross Fund from sort of late 2020 through to now. It's down about 50%. Bearing in mind, this is supposedly a low-risk asset, and it comes back to this eternal question, what is risk? How do we define risk? How do we measure risk? Mr. Hart.
Yeah, I mean, this is very topical. And lots of people who are in pension schemes that have been lifestyle, they've been put into similar type funds before potentially buying an annuity or not. This comes down to our simplistic way of discussing risk. But also it is unprecedented. The inflation we've seen in 2022, we've not seen since 1980. And then obviously this is interest rates being historically low, now rising up. And again, we've had the sort of fallout of the bond on the bond market in 2022, leading into 2023. So we've had 18 months of generally declining prices of long-term bonds. It boils down to frank discussions with clients, discussing with them what real assets are. Real assets provide a rising income and rising capital value over time. The only asset we have access to as professional advisors, in my opinion, is global equities. The other asset is real physical property, provides a rising income, rising capital value over time. So there's been a lot of super cautious investors that's been absolutely hammered by the erosion of their capital. I believe there's 4 flavors of risk. There's loss of capital, there's loss of purchasing power, which is inflation, there's volatility, and there's low returns. So there are 4 different flavors of risk. But what most people and most attitude to risk questionnaires and conversations about risk focus on is purely volatility. And I look at 100% global equity portfolios from various different providers, and I don't even believe they're that even volatile once you sort of understand what you're holding. There's been huge destruction of people's wealth who have been classified as ultra cautious and cautious investors by attitude to risk questionnaires and I suppose inexperienced investment professionals. About 80% of the money I look after is in global equities, because the money I look after is long-term money for people building long-term wealth, maintaining their purchasing power. I've been on a bit of a journey with this. When you first come into the business, you think these attitude to risk questionnaires are the be-all and end-all, and you have to follow them, they have to answer all the questions, and you have to build a portfolio following from it. I've been schooled and educated by the investing greats, Warren Buffett, Charlie Munger, Nick Murray. So I've slowly become more and more pro global equities, which I believe is an absolute wonder asset class and a miracle. Volatility is the emission price to long-term wealth. I'm somewhat concerned that my mighty profession has let down a lot of people who are classified as ultra cautious and cautious, and wiped out a huge percentage of their wealth from something they thought was almost impossible. The key word there is almost. We've seen something that's not happened in about 45 years or something like that. Not in my lifetime. I think it's a big issue. And I'm quite passionate about it. Who's next?
I'll jump in. Not the last 45 years, not in my lifetime, because clearly none of the rest of us can say that. But look, I brilliant stuff, Andy, and you absolutely nailed that, and Nick, you absolutely nailed the annuity argument as well. I mean, they're like that's just gold for so many people. So well done, boys. I would say as you all know, we use the dimensional world allocation funds. Now, obviously, world allocation means a mix between equities and bonds. So do we recommend to our clients a bond holding? In the vast majority of cases, yes, we do, albeit some are in just the World Equity Fund, which I'm in myself. I like your point, Andy, that there are the attitude to risk questionnaires, right? We've kind of learned and developed along the way that, look, no matter really what the answers come back out of that, we got to go and look at your financial plan. And then we got to talk to you about, the types of returns that are required in order for you to live the life that you want to live. So for me, the people who are in, where attitude to risk questionnaires come out saying, oh, you should be 100% in bonds or 80% in bonds. For me, they're the people that you got to talk about. Volatility is the key here. It's not risk of losing all your money. So if you're not willing to put a more sizable chunk of your money into equities, well, then maybe you shouldn't actually be an investor. And maybe they're the clients that you got to, some people you just can't, the education piece that you're trying to do, it just won't get through. And you do them a disservice if, you're going to invest them in a 100% bond portfolio, or if you invest them in a 80% equity, 20% bond portfolio, where when volatility kicks in, they're going to take their money out, right? So sometimes you got to be brave enough just to say, you, Mr. and Mrs. Client, should not actually be investing, right? So that's the first point.
Yeah, you're savers, not investors.
Yeah, exactly. And just some people are going to be like that. Now, very few, if your process is right and you're doing the financial planning, properly, and you're taking the time to do that coaching, educating bit, right? So, there's very few that you'll kind of say, no, not for you. But what I do like, guys, right, and I have to say this is number one, bond returns over the last while, yeah, we know they've been terrible, right? So they haven't done what they were supposed to do, which was kind of smooth out a return over a period of time. But that's in the recent past, right? History tells us, right? So go back to what we always talk about. We invest in what has always worked. So history does tell us that it actually will work if you look at over the long term. And I go through I spoke about this in just the last episode. I go through the dimensional returns page. So it shows the lowest 1 year return for a 60-40, for an 80-20, and for a 100% portfolio. And, people wince when you show them a minus 39 or a minus 40%. They go, it's all well and good telling me that you gave me £1 million and I'm going to show you next year, if you're in the world equity and it had that lowest 1 year return, your value is going to be on paper 600k. Is that going to be okay? Probably not, right? Even though I know it's going to happen and you've told me it's going to happen. So that's why I do think we are better getting people in at a reasonable level than not at all. So I think the human behavior thing does come into it, albeit, have bonds done their job the last couple of years? No, that the answer is they haven't. But having said that, I'm confident over the long period, and Alan's phrase, we're multi-decade investors, over that period of time, they will do their job. So I'm confident that having some level of bond content is the right thing to do. So yeah, we're comfortable in doing that. But Andy, your points are really, really well made. And I think this is a great discussion to have, because it's important just to open these things up, isn't it? Nicholas.
Okay, I'll be quick, so I'm going to segue to Alan, but I think this is the tip of the iceberg. Alan, when we were prepping for this show, yes, dear Trappist, we do prep for the show. You wouldn't know sometimes. When we were prepping for this show, Alan made a comment in the in our agenda that ambulance chaser claims companies are going to have a field day. Now, I think this is really going to take off. I mean, I can only imagine how many advised clients there are in the UK and in Ireland who 10, 15 years ago put a significant wodge of their bonds, and bonds do have a place, but these clients would have put a significant, maybe a 50-50 portfolio or a 40-60 portfolio in bonds, and they're now sitting on massive declines in value. They were put in those portfolios because the compliance thing said tick the attitude to risk questionnaire. They tick the various questions. I will come to you, Andy, Alan. Sorry. I can't remember whether it was Humans Under Management 2018 or 2019 where I said this phrase, Mumbo jumbo questionnaires. So I was doing a riff on the inanity of compliance-driven investment solutions, and it's kind of entered the lexicon a bit now. I hear people say MJQs are mumbo jumbo questionnaires, and they really are mumbo jumbo questionnaires, and they've led to a lot of bad outcomes. And I think it's really going to see this ambulance chasing thing go on, because these, that Vanguard long dated, okay, that's an extreme one, long duration gilt, but that's fallen by over 50%. How long is that going to take to get back to where it was? And these people that are put in there with the nervous investors, they are going to, if I was a nervous investor and I saw more, you could speak to me all day long about it. I am not going to be happy. Alan, what do you think?
I was getting a bit uncomfortable there, because with this episode so far, we've all been agreeing with each other. Makes me a bit nervous when we agree with everything. So I'm going to take the other side. And of course, what everyone has said is all spot on. We're looking at extremes here. If I hope not many people, if any, are 100% in that, Vanguard or any long-dated gilt fund. Maybe some are, and, God help them, it'll take a long time to recover. If you fall by 50%, you've got to rise by 100% to get back to where you were. So, but we do have to recognize we can't have it always. And just to sort of, I suppose, follow up on Carl's point, we do the very fact that we say we're multi-decade investors. We can't get too excited by 1 year or half a year, really, of extreme circumstances. Carl mentioned the Dimensional Matrix book. I've also looked at the other great publication, and the new one has just come out again. The JP Morgan Markets Quarterly Review. But I was just looking at the data on that. And so they go back to 1976. And it shows you how extreme last year was in terms of bond returns. The actual data is that investing in bonds, they do a kind of the Bloomberg US aggregate, which is obviously a blend of different duration and quality of bonds, but it's a decent proxy for bond investing. And they say that it has provided positive returns in 42 or 47 years. So to provide a bit of ballast to a portfolio, it's not necessarily a bad thing. Yes, there was 1 year of extremes, but bonds, I think, do have their place, even if only to manage human beings and human emotion. So that's just one point. I think the bonds have got a place in certain circumstances. But the other thing, and this is just opening out the conversation, I'm interested in you guys' view on this. Carl, you mentioned the point before that everything does, of course, begin with the financial plan. If you model effectively the return a client needs to achieve all they want to do for the rest of their lives, and it says, let's say it's a pretty modest return, it's 3 or 4% or something a year, and they can achieve everything. Give me an argument why you would invest significantly in equities if you can achieve everything you want to do for the rest of your life with accepting less volatility.
Good point, and it does happen. And we can say, okay, well, you only need a return of 2% to live the life that you want to lead. But Andy made the point a couple of episodes ago, and I love it. That we shouldn't be afraid at the same time of creating wealth. So. Yeah. And the way to create wealth is to have a higher exposure to equities. So whilst your return might be required is 2%, and it's all about financial planning, well, then you start kicking in. When people have more than they need, well, then you start talking about legacy issues, right? And it's about passing wealth and that kind of stuff. But we shouldn't be afraid of creating wealth. Not necessarily maybe for wealth's sake, right? But to, embellish your legacy and your family's nest eggs down the line. So but Alan, we have had cases where we only need a return of 3 or 4%. So that's a 40-60 portfolio over the long term. So we'll talk to the clients, we'll tell them what they need, and then we'll have that discussion. But I think all of this is about I'm minded by Nick's mumbo jumbo questionnaires that so our ones go from 0 to 7. I don't know, maybe you have 0 to 10, but if you come out at a 2, this is why tracker bonds are sold, right? So if you do your mumbo jumbo questionnaire and it comes out at 2, you need guaranteed returns. So you go into tracker bonds. So not only are mumbo jumbo questionnaires pretty bloody useless on their own, they also lead to bad behavior. But the easy option for some advisors, and this is my final point is this is all about the financial planning process is a process. You can't rush it. You got to take your time, and you got to, if we're really going to do right by each client family, we we've got to take our time. And therefore, it's not about the sale that comes at the end. It's about what's the process. It's the coaching, it's the education, it's bringing them on the journey and all of that kind of stuff. So hope that kind of half answers it, Alan. If not, come back.
Andy.
Couple of points. I'm sure that UK index-linked gilt fund is probably now a 7 out of 7 on whatever scale they deem important. And it probably went from a 1 out of 7 to a 7 out of 7. So that shows how ridiculous
the
it
LNG
is.
index-linked gilt tracker, yeah.
So that shows how ridiculous it is. The 100% global equity portfolios are now generally 4 5s out of 7 on, again, whatever scale you deem that to be important. I've said it before, the best portfolio is the one that the client sticks to. I'm also got no problem with creating wealth. I don't want to create wealth to just spend it, recklessly, but more wealth equals more freedom, more opportunity. And our financial plans don't include the unknowns. The medical emergencies, the helping out the families, the divorces of the kids. Like, there's so much stuff. We can't just go, in 9 years' time, you're going to need 500 grand out of something that just come complete left field. So,
great point.
So I'm comfortable with a predominantly, more global equity portfolio than the client would end up with. I mean, I call them misconception mirrors. Client fills in a questionnaire. They've got that, they're a financial and investing illiterate. They're coming to us for help, and we give them a misconception mirror, fill them up with financial anxiety, and then put them in a badly performing portfolio. I mean, what's the point in working with an advisor if you're going to end up with a portfolio that you as an investing illiterate would naturally end up with? I mean, we have to put some or a huge proportion of, you're working with an advisor, they're holding your hand, they've built you a very diversified portfolio in the right asset class. And when you are a little bit nervous, you can give them a call. You don't have to push the sell button. So working with a professional advisor and holding your hand over those multi-decades has a massive impact on what portfolio you ultimately end up in. And we just need a couple of years of good returns, and then the clients are happy. But obviously, we don't know exactly what averages we're going to run into. The average long-term return of global equities is about 10% a year, but they do not come in a smooth line, as we all know very well. Back to you, Chairman.
I think it's the value, really, isn't it? It's the kind of one of the core value parts of the value proposition. If you can encourage with your sort of advice, support, information, coaching, if you'd encourage your client to just move 1 degree, from a 60-40 to an 80-20 or something, you've covered all your fees. And exactly. There's no question about that. And so all this, and again, we've mentioned this before, and honestly, but repetition is the mother of learning. You keep saying the same things, but framing is really important. If you just said to your client, your prospective client, do you want a high return or a low return? That's another way to say.
Yeah,
I'd like the high return, please. You can have the high return. It does come with a little bit more volatility, but this is how it plays out. Would you prefer? Or you can have the low return fund if you want. So but I just think but I think this is really interesting in terms of this discussion. We're all talking about it here. What's happened to all the kind of the risk profiling zealots? What happens to the companies that have got to take accountability, responsibility? The ones that
they've
have
all sold their companies
these
for tens of millions and buggered off and put it in 100% global equities. That's what they've done. I've sat with some of them and bought them bloody pints, even though I know they're worth tens of millions.
But I think as well, it's about having the integrity to to continue even when it's a little bit difficult sometimes to do the right thing by the clients. To really stick to your guns and say no. This is because I don't know if you've these silly structured product things over there and like there's some now and it's like it'd be so easy just to say oh yeah, we'll stick your $1 million in there and we'll leave it back.
You underestimate the power of the dark side.
And the commissions on them are much higher than if you do a 60-40 portfolio. So, it's about having that integrity, sticking to your guns.
Keyword,
and it's all about financial planning. And financial planning is a process. It's not a once-off. Therefore, a once-in-40-year return in bond funds for me is largely irrelevant, but I'm aware.
Yeah. Those structured products, they are aesthetically pleasing, aren't they? To the non-expert, they just sound really nice. You sort of guarantee your money back and guarantee a certain return, smooth return.
Smooth, yeah, they love that.
They are hugely popular. The bank's still selling tons of them.
Only available to sophisticated investors.
Yeah,
which mean, AKA rich idiots. Anyway, moving on.
Yeah, it's like these sort of get rich property deals you see on the banners that pop up. Guaranteed return of 12%. Well, if that's true, why aren't you doing it yourself and keeping it quiet? With these structured products, you feel like saying, well, why don't you're a massive PLC, just invest all your money in if it's so good and just keep it away from the retail investor. Somebody somewhere is having a fine lunch on those products, and somebody somewhere else is getting turned over. Have we done that to death, do you think, chaps?
A good discussion, though, guys, and lots of different points. So I think,
it's the perennial one. And Carl, your point as well, mate. I mean, and we've talked about this before, that you, as an advisor, you have to have a set of core beliefs. You have to have an ideology, right? You have to go into a meeting with a client knowing that this is the way I want this meeting to go. Okay, I'm bringing my thoughts into this, and this is the way it's going to go with this client. Yes, all clients are different, but I'm going to bring my beliefs into this meeting. If you've got to, you're a ship at sea, and we're being buffeted all the time by news and markets, and these waves are crashing over us. And we put an anchor into the ocean, and we're going to stay pretty solid. The advisors who are weak, who haven't got an anchor in the sea, are just getting pushed and pulled by today's events. You're absolutely lost. So you've got to be quite dogmatic. I'm not saying that you've got to have views that I agree with, but you've got to have your own set of views and apply them, because that will see you through all the cycles. If you just change if you try and be a chameleon, you'll be nothing to anybody. You'll try and be all things to everyone, and you'll be nothing to anybody, and you'll be lost, and you'll have complaints coming in left, right, and centre. On that joyous note, I think I can see on my little Nest camera that there she is, Posty, dropping off another sack full of Trappist questions. These are questions posted to us by our beloved Trappist audience. There's a pinned tweet at Advisor Podcast. In there is a link you can click on, and you can leave questions. We will get to them. We're still working through a backlog. I think I'm up to January or February of this year with today's 2 questions, so please do keep them coming in. Let's have a look here and see who's first on the list. I've got to get my letter opener out. This is from Adam H. He's on LinkedIn. Adam says, thanks, chaps. Love the podcast. I'm interested to hear a discussion around how... Oh, God, this is a big one. I'm interested to hear a discussion around how you all deal with IHT planning. Thanks, and a thumbs up. I'll go very quickly first. I don't do a great deal of IHT planning in the sense of trust and so forth. I deal with sort of mass affluent families, and by the time you've arranged their affairs so the pension fund is outside of the estate, so you spend everything else down in retirement, £1 million between them, husband and wife, the exemption's pretty generous. I do use a third-party firm. I've started using a third-party firm called, it's not the greatest name because it sounds a bit like a swear word, it's like Kinherit, who specialise in trusts and wills. I'm of the mindset that the older I get, the more I know I don't know, and I'm specialised down and down and down, and outsource everything to people that know what they're doing. If you're doing trusts, do them all day long and make that your speciality. And firms like Kinherit or Solidus just do trust. So I refer clients to them for people who want specific trust work done. They want 200 grand for each of the kids to be used for a property purchase later on, but they don't want that money going to their the ex-wife or the ex-husband of these children should their marriages break down. Already I'm going, okay, I'm out of my depth. Refer to a third party. That's what I do. Guys, any thoughts on inheritance tax planning?
I'll jump in just from the Irish point of view. I know the rules are probably a little bit different. So we use bare trusts for the small gift exemption. So that is what it is. We do. Royal London here have a great Section 72 life policy, which basically gives people the option to take the money back if legislation changes or whatever, you have to pay the premiums for 15 years. It's a joint life, second death policy. Oftentimes talking to clients about gifting the kids their inheritance tax threshold before, not trying to do it from the grave because kids might need the money earlier. And then we've only a few times, maybe 3 or 4, done with the tax advisor, set up family partnerships, that kind of stuff. It's complex though, and you want to know what you're doing, and I would engage tax advisor along the way for sure.
Absolutely. We'll come to you in a second, Natty. Just remind me, Carl, I should know this. Personal pension funds in Ireland, are they part of the estate for your equivalent of inheritance tax, or are they outside of the estate?
It depends on where you are, whether you're pre-retirement or post-retirement. But yeah, most of it is outside of the estate, so it's taxed differently, and then it's just dealt with, and then your estate value is your estate value.
Okay, that thank you. That changed when it was in the UK, when effectively it was put outside of the estate, was I think the biggest change to taxation in terms of financial planning that I've ever experienced in my career. Andy, you had a digit waving in the air.
Yeah, somewhat similar to Nick. I do spend quite a lot of time actually discussing this with clients. Maths affluent, but a lot of people are now got caught up by this. Similar to Carl, just going to go through the options. Obviously, the first option is do nothing. I think it's quite polarizing. People are either do nothing, I'll just deal with it down the line. I pay, I'm not too bothered. I've created wealth. Or other people are, I don't want to pay a penny. It's very rare that they're sort of in the middle. Like, nah, do you know what? We should do a bit about this. Maybe it's always like, right, I couldn't give the monkeys. I'll just kick the issue down the road. Or I've got a real concern about it, and my father, my uncle, my mother, had a bad experience with it. So obviously, it's do nothing, pay the bill. The next up is obviously give the money away. And we all know the rules around that. The next is insure it, which is Carl mentioned Section 72. We've got similar sort of whole of life type of policies. And then the third one is a little bit more convoluted, but it's around trusts, BPR assets, loan trusts, and various other things. So it is a huge area in the UK, and there isn't anything, there's no sort of elegant, simplistic solutions around it. So it's something that we all discuss with our clients on a sort of year-by-year basis. But in terms of actually addressing the problem, sometimes it's kicked down the road. Over to you, Alan.
Interesting what you say there. Often when I would speak to clients, take on new clients, and I ask one of the sort of open questions is, what do you think? What's your views on tax? And almost everyone said, I don't mind. I recognize we've got to pay for, all the stuff that keeps us, for the police and the teachers and all that stuff. But I don't like inheritance tax. Most people have got this view. I've already paid a ton of tax throughout my life, and it's quite an emotive subject. But a lot of the conversations that I've had, I did have one when having had like about 10 of those conversations back to back with clients and prospective clients. And then I said to this other new prospective client, you probably don't like to pay inheritance tax. And he was outraged. He said, absolutely, you should. Everyone should pay it. It's our civic duty. We should. So I thought, okay. So it does. But I think that's the only time that ever happened. Yeah, I think like everyone else in the past, I have set up, years ago, these AIM investments you can put out, and they are inheritance tax free after 2 years, investing in AIM stock. And just got lucky with this one we did. We invested quite a lot of money for quite an elderly lady, and probably at the absolute bottom of the market, 2008-9. And it sort of trebled in value quite quickly. So that was quite useful. But then we did some analysis on it, on these sort of things later. And actually, they are expensive. You look at the fees and charges, they can run to the best part of 3% a year. And they got spreads and all that. And these sort of smaller liquid companies. And you don't have to live too long to sort of to have the returns. And if you don't have really stellar returns from this, and obviously it's a very sort of high risk micro company type investments, it's a gamble that's probably not worth paying for, I don't think, or worth taking on. So we don't do much of that. The one thing that hasn't been mentioned, which we have done a few of, and they really are for more the kind of, very wealthy, I suppose, or people with 5 to 10 million pounds of liquid investable assets and above, family investment companies. You guys have ever looked into these? No, generally set up by lawyers. Effectively, it's a company. It's a limited company that you can put a lot of assets into. They are pretty IHT effective. I'm always wary that they're going to be attacked.
Very questionable,
because they are effective, and they do work, and you can put a lot of money outside of your taxable estate. So for those with significant wealth, because they're not cheap to set up, they do cost running into 5 figures. You've got to appoint trust companies, you've got to appoint a lawyer, there's ongoing costs, there's tax returns going to be made. So, but they can be worthwhile looking at for seriously wealthy people. Yes, Andy?
We've spoken about it a little bit, Alan, is a lot of these schemes end up just saving the tax but not growing the assets. So we say you might as well just grow the assets in a traditional way, and after a couple of years of good returns, you're probably in a net better position, even if you still have to pay the 40%, because they do this thing called wealth preservation, which again is something that the wealthy like, which is again financial madness. But yeah, flatlining your wealth forever, but it preserves it. But we'll just still take our 2.5% fees for preserving your wealth, Mr. and Mrs. Multimillionaire.
I know. And what this, and it's kind of just seems to me it's the recurring theme of this podcast, all roads lead back to simplicity, effectiveness. Because I agree with you. You invest in the capital markets, let it grow. You will then have the opportunity to be more and underpinned by a solid and annually reviewed at a minimum financial plan. Gifting your assets becomes a really meaningful thing, and that's a whole other conversation. And I've had many of these conversations with clients. in an ideal world, you want to gift your assets and your wealth in your lifetime, whilst you can see the benefits of your money to hand it over to your kids, grandchildren, paying for grandchildren's education, things like that, really meaningful stuff that you can happily see, as opposed to, something that has, some convoluted trust thing that sends money to your beneficiaries after you're dead. You never get to see that.
Yeah.
So I honestly, I just think the idea, keep it simple. We can review all these fancy schemes, but I'd be eliminating 99% of them, frankly.
Some advisors setting up like 60 trusts for families and stuff. Sorry, Carl, over to you, mate.
Yeah, no, I just on that theme, right? I especially for new clients, right? When they come in, new financial planning clients, and we have tons of work to do in the first year, or maybe even over the first 2 years, unless it's absolutely top of their agenda about inheritance tax, we always say that's phase 2. Phase 1 is getting absolutely everything set up now, get you comfortable with the plan, get you knowing exactly how the plan works. And once we're comfortable and you're comfortable that everything is working as it should be, and that we can then still see that there's going to be legacy issues in terms of extra money down the line, well, phase 2 is to look at inheritance tax planning. So I would just, after all this is for other financial advisors, that's my experience. If you try and bring it in too early, it adds a lot of complexity for all the reasons that we've just discussed, and you might lose people. So keeping it simple at the start and just focusing on the real core stuff, and then do that as phase 2.
I totally agree with you, Carl. There are advisors out there that immediately look to save clients inheritance tax, and all their focus is on that. And yeah.
I would just have a word of caution about that, again, based on personal experience, when I had a client who came for us for the sole reason of inheritance tax. And I said exactly that. I said, we'll come to that. And he said, no, we start with this. And I do think occasionally you got to meet the client where they are. You got to start talking about these things.
He said that.
I did say that. We had one last week, and they know in their intuition said we're going to be okay. Inheritance tax is the big thing because they sold a family business and felt, well, I got to look after the kids, but whatever. So that does happen. But if it's not number one on the agenda, I'd be trying to ease it out, because the inheritance tax issue is going to be there next year and the year after and the year after. And we can, you have a bit of time in your hands.
All right. Sorry, Carl, just proving that I wasn't 100% paying attention to what you just said, as you did the same to me a couple of episodes ago. There we go. You got my full attention now.
Drawing a line under this, I had a prospect initial planning meeting last week. Prospects referred to me by existing clients as per normal, and their front of mind thing was, we want to gift away 600k to our 3 children. Can we do that without later on running out of money? So they brought it to the table. It was their key thing. So we did the financial planning based around that, and the cash flow showing, this is if you don't gift the money away. This is if you do gift the money away. Will it put you in penury later on? It turns out it won't. So let's crack on and do that. And these are the clients I've referred on to a specialist third party now to do the trust work. And those prospects hopefully will come back to me when that's been done. And then we can help with investing for their future selves and their impending retirement. So it swings and roundabouts. Right.
And on the cash flow, Nick, did you put gift to urchin 1, gift to urchin 2, gift to urchin 3?
What's wrong with that?
It's fine.
Right. Let me open up the final question for
we
today.
We should do these on Tuesday or Wednesday. Everyone's a bit testy on a Monday.
This is. By the way, you're putting.
Don't give away when we're doing
the
it,
drops
Carl.
in the
This
chat.
Is
There's no chance to do the drops. So I'll do them when I can.
Yeah, where's the
Michael
soundboard,
Walsh.
Nick? You're slacking. One of us needs to take over the chairmanship role
Alan
next
did a
time.
story earlier on, then told me not to do it, so I didn't do that. Carl has not made particularly Irish references. Now, you've not said how great you are, but that's got to be coming because your head's going to explode if you don't get it out. Let's just do it anyway. Let's just do it. Christ.
Which one's this?
The ultra crepidarian Andy. He knows about everything, Andy. Can't be told anything. His name is Andrew Hart. Andrew Hart.
Okay, thank you. Right.
I've got to say, it's so good.
Nick. There's another
it's so
question,
good.
Nick.
We are coming on to it, but he knows about everything. It's just so accurate.
I know a little about it, all right?
Yeah. Shallow, in other words. Okay, Michael Walsh, you put in the question, my friend. Your question, thank you. It's a 3-paragraph one. I do like these. Here we go. I'm currently coming to the end of my 3rd year at university, and I have purchased RO5, financial protection, to complete over the summer. Wow, mate, you sow your seeds. I currently work for a third-party firm processing the administration for a wealth management company and have done so for 6 years. this December. I'll let you guess who it is. I've already done the Darth Vader drop. I'm not doing it again. I think we know who that is. As a result, I believe that I have a level of experience that very few people applying for similar junior advisor paraplanner roles will have. My question is, on top of completing my RO5 over the summer, is there anything else you could think of that would help me to stand out when applying for jobs at the end of the year, or anything either of you would specifically look for in the recruitment process? Cheers. And he said either of you, so I think he's inferring that this question should go to Carl or Alan, although Andy's got his finger raised.
No. Go to them guys first if you wish.
But Andy knows about everything. He knows
Alan, come on, guys. This is, 70 minutes in. I'm going to kill somebody soon.
Right. Go, Carl.
We can feel it. I would say, look, I don't know if the market is the same in the UK, but in Ireland, certainly there's people always crying out for good people, and there's lots of people recruiting at the moment. So, having your examples ready as to why you feel you're better than all the other junior paraplanners for the interview, I think just having that prepped. I would go to the recruitment firms, and have a chat with them, because the really good recruitment firms will put you forward and tell the prospective hiring firm why you're that little bit above the other kind of junior people. For me, I had a young fella in last week, and I was just saying, expand your LinkedIn network, that kind of stuff. I know Nick will be wincing at that, but it does work, and it is important to have all of that looking as professional as possible, because that's what we do. We look at the LinkedIn profiles before we even consider somebody. But having that little bit of experience nailed on in a very short CV. Do not have CVs that are going on and that are really, really wordy. Bullet points, but explain what experience you have.
One-page CV?
I'd love a one-page CV. Yeah, one-page CV would be brilliant.
Alan?
The question was to do with how do I stand out? How do I make a difference? I was. So do something that others don't do. I've often referred to Loom video. Make a short video. Make a 2-minute video about why you're good.
Yeah.
Email it to it. And there's another thing. There's an idea that another close personal friend of mine by the name of Jack Butcher. He is met him in America. That he's got this concept. Jack's very popular on Twitter and social media, and he's a creator and a designer. But he talks about this idea of the permissionless apprentice. You ever seen this, where you go and do some work without permission for somebody, someone in profile. So I think the advice to Michael would be, do your research, find out the companies that you want to work for, because as you're right, Carl, go to recruitment companies, fine, but you kind of lose control over it. There are such a wide range of companies out there. You've got to try to identify with one that you really, or a handful that you really like. You like the culture, you like the ethos. So it takes doing a little bit of research. So go online, check the websites, check the social media profiles of the companies you'd like to work for, and do something for them. I tell you, for me, if somebody just sent me a video or sent me a short piece, an article or something that was relevant to something I'd complained about or written about or wrote a LinkedIn profile or article about, and he said, I read this thing that you were having a challenge with. Here's my thoughts on it. Here's my idea. I would have that person, in the office in a heartbeat. You've got to do something to be different, to stand out from the crowd. So, make video, permissionless apprentice.
Cue Alan getting 25 Loom videos next week from university students looking for a job.
Always looking for great people.
You're right.
But on that, so we're recruiting at the moment, as you know, and I've got loads of direct messages on LinkedIn, right? And people who've bothered to actually send me direct messages on LinkedIn, I've engaged directly with them because they've obviously listened to what we've asked for, and I said send DMs. So just being a little bit proactive.
I think the Loom. I mean, look, it's just using the imagination, isn't it? I mean, if I was a business owner, say Alan or Carl at Metis Norway, and I got an email from somebody, 2-minute Loom video saying, Carl, love your firm, really like the work you're doing in these areas. I've noticed that you do this and this. Just to let you know, I've put together this proposition that I think could work really well for your clients. Whatever, just 2 minutes of your time, and it's a video embedded in an email. It's like you stand out from the crowd, don't you? As you say, Carl.
And I promise, as Alan says, I would engage with that.
You get these War and Peace CVs which tell you nothing, and it's just like, or LinkedIn even, but something like just using the tech to bring yourself to life to people that have never met you before, and you've got a short attention. We've all got short attention spans. We're all busy. Some are busier than others. Make it impactful. Make it impactful. Okay. Brilliant.
Couple of points before we wrap this up and tie a bow in it. So the first one, obviously, you're going to say man with a hammer, but I recommend that you learn Voyant financial planning software inside out. Forget this called Voyant. It's a financial planning software. It's a separate skill. And people do look for Voyant skills with recruiting younger,
And do you have any courses coming up now that he could
Shut up. The next thing...
12th of October. 12th of October.
This episode sponsored by Voyant.
The next thing, which is a follow-on from the Zoo... The next thing is a follow-on from the Loom. Why don't you just set up a website? Go to squarespace.com, buy youngadvisor.co.uk. It will cost you 12 quid. It will take you an hour to build a beautiful website and send that link to people. Do something slightly unusual and creative. It costs you nothing, and it will show you have initiative. And also, back to Nick's point about CVs, don't have a BS Word CV that looks terrible. Create something beautiful on Canva. Again, it will take you half an hour. So learn financial planning. People do look for that as a skill for recruiting young people because they can't be asked to do it themselves, long story short. So if you can save them time, hassle and energy and effort, they'll employ you. And then the next thing is set up your own website. And the next thing is create a beautiful CV. I get sent terrible CVs from people telling me, I'm a young, creative, innovative, please find attached my CV. And it looks horrendous, like something about 1993. It's mind-blowing. So, yeah, there's my 3 little tidbits.
Okie dokie, great stuff. We're now at 75 minutes in, so I think we should move without any further ado to Culture Corner. And I've got a couple of them. Firstly, I'm wearing the first thing today. So I've got 2 today. The first thing is a tech thing. Soundcore Liberty 4 noise cancelling headphones. I think they're the best you can get. They were 75 quid. They were doing a 25 quid off thing. They came out a couple of weeks ago. I'm wearing them now, as I said. Brilliant, comfortable, 50 hours of battery life, noise cancelling, just work, really good app. Thank you, Soundcore Liberty 4. It's from the Anchor stable. Soundcore. Okay, my next thing is a book. You guys might know this one. It's called You Are Not So Smart by David McRaney. And it is 48 chapters on how we kid ourselves all the time. And each chapter deals with things like logical fallacies and just all these things that these heuristics that we use to cope with life. Because if we didn't have shortcuts and mental shortcuts, we go mad. There's just so much going on all the time. So we use these shortcuts and we tell ourselves stories. And this book just breaks them down. You do X because you think it's Y. Actually, you're doing X because of Z. How could this help professionally? Well, we have to know our clients, right? We have to know our customers. And you never know anybody. We don't even know ourselves. If we don't know ourselves, how can we know our clients? But if you read this book, it might just give you an insight. If you've got a client, whenever you suggest something, he or she reacts in a way you don't quite understand or expect. Read this book and I'm like, oh, do you know what? That's why Betty is doing that. When I say that to her, that she gets this reaction because of that. Really good book. Just so the chapters are short. I'm going to read it, actually. There's so much in it. You Are Not So Smart by David McRaney. Mr. Smith, the Shocks Open Run Waterproof Bone Conduction Headphones.
Yeah, I've got a couple. That's very interesting, Nick, what you just said. That looks
I'll
like
be
a
reading
really
that book
good
for sure.
book. I'll get that.
Yeah, you'd love it. I think you guys would love it. All of you love it.
Yeah, sounds good. Yeah, I mean, we're headphone focused right now. Have I mentioned that I'm on holiday? I'm on holiday this week, and this is the summer holiday, so there's a lot of just kind of sitting around and eating and drinking and so on. And but I do try to do a little bit of exercise, and there's a beautiful swimming pool here, and I like the idea of swimming up and down, doing some lengths to do a little bit of exercise at least once a day. But I find swimming exceedingly boring, just back and forward, back and forward. And so I thought what would be a good idea would be if I could listen to podcasts whilst I was swimming, then I'd be more encouraged to do it. Obviously, the challenge is waterproof headphones. So I did a bit of research and I found these ones. Have you come across these ones that are kind of on the bone? They don't go in your ear. I don't have them with me.
Yeah,
they don't actually go in your ear.
Bizarrely. Because the sound gets transmitted. I mentioned these earphones that don't through the bone conduction. That the sound vibrates up your jawbone. Yeah.
It's incredible, and they're completely waterproof. So I put a link to them. The ones that I found, Shocks, SHOKZ,
130 quid for headphones you can listen to podcasts while swimming, doing about 9 lengths in Turkey for a week. That's pretty punchy for you.
30, at least 30 lengths, 100-meter pool. Anyway, they're really good, and as a consequence, I have listened to, and this thing is not just thrown together, I've listened to quite a few podcasts so far in the last week. Carl's already mentioned this one, but I did listen to it, and it's brilliant. Dan Carter on the high performance. I won't go into it again. There is but there's a phrase in it that I like. I think I'm going to give you this one, Hart. So you're going to love this. He talked about he's had a lot of coaching and sort of corporate athlete. That's not that one. No, he talks about in life. You've got to be a poet and a plumber. It's poetry and plumbing. It's the arts. He talked about leadership. Strong leaders are poets and plumbers. You got to do the basics. You got to do the normal stuff, the plumbing, but you got to add a bit of artistry. And I think the best financial planners are both poets and plumbers. Do you like that one, Andrew?
I like that. It's fantastic. Brilliant.
So basically riffing on my art versus science thing that I go on about all the time. I agree with that.
Well, I talk about plumbing and admin, and the poetry is brilliant. Yeah, I love that. Thank you.
Just very quickly, your resort... sorry, I'm floating around here. Your resort in Turkey, you're on the Aegean Sea, aren't you?
Correct, we are, yeah.
Is it sandy or pebbly?
Sandy. It's beautiful.
Oh, win-win.
Really, really nice. But so that's not my culture corner, because that's Carl's one, Dan Carter. But there's that. You better have that phrase. But the podcast I've just listened to at the moment, it doesn't sound very interesting, but it is brilliant. Have you listened to the Invest Like the Best? The Patrick O'Shaughnessy, good Irish name. Invest. Yeah, a few. Invest Like the Best. Yeah, but he's got this. I've never heard of this guy before. You heard him before, Jeremy Giffon. Anyway, he's private market investor. Sounds dull. Special situations in private markets. But somebody recommended to me, and it is really, really good. It's just a lot of stories about life. It's just really interesting.
Okay.
That podcast. Well worth listening to. I'll post a link to it in the show notes. That's me. Thank you.
Okay. Thank you very much. Carl, the Melissa Caddick story.
Yeah, Melissa Caddick is Australia's very own Bernie Madoff. There's a 9-part series, a podcast series. It's very, very interesting. And I suppose the point is that no matter where you go in the world, there are people who are going to try and swindle other people out of money and make it look, kind of like they are doing what kind of we are doing. So I think it's really, it's a very interesting story. Some of it you'll be just gobsmacked by. But then the learning or the lesson is, to make sure we're telling people about our corporate governance, about, where the money is going, how safe it is, where it is going and that kind of stuff. But yeah, it's really, really interesting. Mental stuff going on there. But and it's very, very,
listen to it.
Very live. Yeah, it's like
you've listened to it, have you as well?
Yeah, I have. I listened to one of them. I haven't listened to all 9 parts of it, but it's a real sort of literally murder mystery. So it's a fascinating story. Yeah. The best stories are fact is better than fiction. They're just dark. It's just kind of crazy. A lot of stuff that went on. There's a lot of sort of family and friends and neighbours. They've been completely wiped out financially.
Yeah. Well, what happened to her? And I won't give it away because it is like a murder mystery. It's really, really interesting.
Okay, because I find that kind of stuff fascinating. I still find the Bernie Madoff thing fascinating. Even like 14 years after the event, it's still like Jesus, how?
Yeah. The podcast is hosted by 2 Australian journals, and I can absolutely promise you, Nick, they're going to drive you mental.
I'll try and look past it, but I will listen to the Andy.
I've not mentioned on here before, but a podcast I like. I think you listen to, Nick. I support him on Patreon. It's called Swindled. And he talks about all of these different scams around the world. It's absolutely brilliant. And it's sort of him sort of producing the podcast, narrating it, doing all the research. Yeah. It's a real passion project for him. I think he's on about 5 or 6 series. It's called Swindled. Definitely worth checking out as financial advisors.
Very dry, isn't he? He introduces it. He's very dry-toned and sort of corporate scandals. Wow. Okay, I think that's the end of culture. Oh, Jesus, thank God for that. 83 minutes. Right, I think, gents, that is a wrap for this episode, yeah? Thank you very much. I think that was a goodie. That is a wrap, dear Trappists. So as ever, please do leave us questions for us to come back to. Do leave reviews either on iTunes or on YouTube. If you do leave a review and you wouldn't mind, please stick in your Twitter handle within the review so we know who it's from, and we can just then reference you in the show notes and get the sense of community building up. I think that side, until the next time, from the Trap Pack, it's adios and take care out there, folks. Goodbye.
Bye-bye.
Bye-bye.